Equities continued to move higher in May, gaining 1.6%, but were more volatile in recent months, with earlier gains of almost 5% being given back over the last 10 days. Having initially benefited from the interest rate cut of 25 basis points by the ECB and the promise of measures to boost corporate lending in Europe, combined with better economic news flow and rate reductions from other central banks, uncertainty was introduced when the debate was reopened over the timing and extent of the reduction of the level of monetary stimulus in the US. The Japanese equity market succumbed most to profit-taking, having been up over 10% for the month and 50% year-to-date, only to finish the month down 2.2%. Eurozone bonds were weaker, falling 2%, with yields rising due to the better economic data and possibility of lower levels of global central bank buying of government bonds. The euro fell to 129.60 against the dollar, with the potential for tighter monetary policy in the US and looser policy in Europe. Commodities slid 1.4% as economic data disappointed in China, while gold fell 5.4% as global inflation remains low. Having appeared to back away from an early reduction at the beginning of May, comments from Fed Chairman Ben Bernanke and minutes from the recent policy meeting suggested tapering could begin in coming months. In testimony to an economic committee, Bernanke appeared to maintain an easing bias by highlighting the risks to the economy of an early tightening of policy and that the labour market remained weak. But in Q&A, he admitted an easing of QE3 could begin in the next few meetings. The Fed minutes revealed that a number of members believed an easing should begin by the meeting in June. However, both Bernanke and those in favour of an early easing of purchases indicate that any decision will be dependent on data flow and will only be justified if there is convincing evidence that the recovery in the labour market and economy are sustainable. The key release to watch will be the non-farm payroll figure, and if this is around 200,000 for a number of months, then tapering is likely to begin. While the US economy is improving and appears to be exiting the recent soft patch, job creation of 200,000 per month will be difficult to achieve over the summer. And with inflation remaining low, we believe it will be later rather than sooner when the Fed begins to change policy, and the market might be premature in expecting an early tapering of QE3. Following disappointing economic data in April, the tone improved through May, although it remained mixed. US consumer confidence hit a 5-year high, while retail sales, the housing market, and durable goods orders all exceeded expectations, although industrial production, ISM manufacturing, and regional manufacturing indices disappointed. In Europe, most sentiment indicators improved after recent weakness, with manufacturing PMI at its highest level since February 2012. In the UK, manufacturing and services PMI and industrial production were stronger, but the mix within first quarter GDP disappointed. In Japan, first quarter GDP grew 3.5% annualised. Chinese data was mixed, but overall behind forecasts, with growth estimates for the year being revised down towards 7.5%. Overall, the global economy remains firm and should improve in the second half of the year. Equity markets are down about 2% month to date. Since 1960 in the US, there have only been 3 years without an equity market correction of 5%, so the recent moves are not unusual. Markets might remain volatile in the short term until there's greater clarity, but with a tapering of QE3 likely to begin later rather than sooner, and only when the economic recovery shows evidence of being sustainable, we believe equity markets will move higher again through the second half of the year. Bonds, on the other hand, are likely to remain under pressure, with yields increasing further.